We do something that is very different to what most people are expecting. And really that is to solve a major problem for homeowners who have a significant amount of equity in their homes, but don't want to borrow more money or simply can't borrow more money. So we have a way that enables homeowners to access the equity in their homes without taking on more debt. So that means that we can provide capital, in some cases up to $500,000 to a homeowner with no monthly payments, no interest, no added debt. They can use that capital for whatever they want. So they can use it to make an investment in another property. They can use it to pay down expensive credit card debt or any use that they want. And the way that we do that is we're investors and not lenders. So what we do is we partner with the homeowner, and in exchange for a cash lump sum, we get a commitment from the homeowner that when they sell their home, we get a share of the percentage of the value of the property at that time. So what we're doing is we're saying we'll give you cash today based on the value of your home in exchange for a share of the value of your home at a pre-agreed time in the future. So, and that time can be any time in over the next 10 years. So effectively what you're doing is you're selling us some of the future value of your home in exchange for cash today. But what's really important is if you're a homeowner and you've got equity, but you don't want to go deeper into debt, or you may simply not qualify for a HELOC or a cash out refinance, this is a way that enables you to tap into that equity. And it really depends on who you are. You may want to use that equity as a down payment on another investment property. So it's a great way of diversifying out of your home equity without having to go back to the bank and borrow more money.
That makes a lot of sense. That makes a lot of sense. Well, so I'm super excited. I know our millionaires have a lot of questions, as do I, about that process, how you guys qualify. And, Matthew, as we are, continuing on with our conversation, again, I just want to welcome you to the $1 Million Mind podcast for the first time. And I want to welcome our guests who are tuning in for the first time and some of our vets. This is the #1 community for self-mastery and abundance by having $1 million conversations with really dope people like the one we're about to have with you, Matthew. So super excited. To our millionaires, this is the only place, right, for you to get money-making tips and tricks for finding your passions and attracting opportunities to create the life of your dreams. So, Matthew.
All right, what's up, millionaires? So I know I shared this once, maybe even twice, but here's the third time. So I'm really starting to lose faith in business cards. And the reason why is because every time I get about 500 business cards, I use about 100, 150, and my business has changed. Whether the website has changed or just things are just changing, especially when you're a new entrepreneur. I've been in entrepreneurship just under 5 years. So, things are still changing. You're optimizing, you're getting new websites, getting new Instagram accounts, and your business card really expires. So what I learned and what I love now is Popl, right? I have a Popl card right here in my pocket. And what I love about it is it's a physical card that I can put my logo on. Even has a QR code that I can scan or hold up to somebody's phone. And they have a virtual business card where I can update my information as much as I need to. I can share as much information as I want to from my phone number, social media pages, the whole nine. And I can also disable sharing that information if I want to as well. I definitely want you guys to consider Popl, because as your business is changing, why spend so much money on these paper business cards when most of the times people throw them away and it's expired because you changed your business? So there's also going to be a link at the bottom of this video for you to download Popl, get your business card, or if I hold it up close enough, you might be able to scan that QR code.
Matthew, you talked about pretty much a process that not a lot of people are familiar with as far as getting huge lump sums of cash, for their home, but still being able to live in the home, still have ownership of the home at the time. What is your guys' process for qualifying the homeowners, or even qualifying the homes that make sense for you guys as investors?
The most important difference between what we do and what the banks do is that we primarily focus on the property as opposed to the homeowner. So in other words, first and foremost, we're going to say, where is the property? How much equity do you have in the property? What's the property worth? And do we think it's in a location that's going to appreciate? And then we'll start looking at the homeowner and we'll say, what's your credit score? And have there been any negative events in the past, such as a bankruptcy or maybe missed mortgage payment, something like that? That's going to be quite important. What we don't do is we don't worry at all about what your debt to income ratio is. We don't worry about your income or whether or not you are able to verify all of your income, all of the things that the banks really focus on, things like how much you earn and how do you prove that. That's not really important to us, because what is important is that there's enough equity for you to be able to sell us some of the future value, some of the future equity, and that the home is in good repair, and that you're likely to be able to continue to meet your obligations going forward. So the process for underwriting is a lot easier, a lot quicker, and a lot less painful than going through a typical loan. And really, you can go onto our website and put your property address in, and it will give you an instant estimated value, and we'll estimate your existing mortgage, and we'll tell you there and then whether or not we think we might be able to help you. And if so, how much we think we might be able to unlock or access for you. And then you would simply give us your name and your details, and then one of us will contact you and take you through the next steps.
Awesome. So I'm more of a numbers guy in order for me to kind of visualize this, Matthew. And let's say I have a home that right now on Zillow, and I'm playing quotes because as an investor, I know we don't like to just use Zillow as a basis for how a home is valued. But let's just say Zillow says my home is worth $450,000. That's the Zestimate. And I currently have a mortgage left on the home of $200,000, and my mortgage payments are about $1,200 a month. So how would I be able to unlock the future value? If it's currently $450,000, like, do you guys see that maybe 10 years from now it'll be worth $700,000? How does that work if by using those numbers, if you could?
Right. So you've got about 55% equity. So if your home's worth $450,000 and you've got a $200,000 mortgage, you've got about 45% approximately is your existing loan to value. So the first thing we do is say, is that less than 75%? The answer is obviously yes. And then we're going to say, well, how much can we invest? So let's, for the sake of easy figures, let's pick 10%. So we're going to say we're going to invest 10% of the current value of your home. So that's $45,000. Now, obviously, if you wanted 20%, that would be 90. But let's call it 10%. So, and we're going to add that $45,000 to your 200. So we're going to say 245. What is that as a percentage? So if we have a combined investment and mortgage, that's about 55%. So that's obviously less than our 75% threshold. So the first thing is you pass that test. So you know, you've got enough equity for us to be able to make that investment. So we're going to invest 10% of the current value of your property. And in exchange, you're going to give us 16% of the future value of your property. So when you sell your property, or if you decide to refinance, what we'll do is say at that time, and that time can be any time in the next 10 years, what is the value of your property on that date? And we can do that through an appraisal, or you might have decided to sell your home, in which case we can use the sales value of your property at that point. But let's say you sell your property for $500,000. What we would do then is you would pay us 16% of the value of the property at that time, and that would pay us off in full. You would have had use of that $45,000 for the entire period, and you would have had no monthly payments, no interest, and there would be no other, fees or costs involved. Now, the other thing is, if the value of your property went down to say $400,000, it would still be 16%, but of that lower figure. So the real difference between us and a loan is that the loan stays the same. It doesn't really matter what the value of your house is. But if the value of your home goes down, the home equity agreement will get back less. So we would get 16% of 400,000, or let's say, God forbid, that the property goes down to 350,000. Then we would get 16% of that. So we take the risk both on the property going up, but also the property going down in value. So the way these agreements work is effectively you're selling us 16% of the future value of your property in exchange for 10% of today's value. And that same ratio works. So if you want us to invest 20% of the current value, then, which is 90,000, then you would pay us 32% of the future value. So it's that straightforward discounted equation.
Okay. So are you guys leaving it up to the homeowner as far as what they use those funds for? Or are you guys pretty much? Okay.
No, and that's one of the real important points about this is, unlike a bank that might really force you to spend the money on something like home improvement, if you say to the bank, I'm going to use the money to put new windows in, then in many cases they'll say, okay, well, we'll give it to you in stages, and you prove that you're putting the windows in. So they'll, tie you up in all sorts of knots that way. With us, really, what you're doing is you're selling us something that you already own. So the equity that you have in your property is yours. You're selling it to us, and therefore the money that you get is yours. So you should be free to spend it on whatever you want. So you really can use it for anything. And this is a very important point. It's not a loan. So it doesn't go on your credit report as another loan. So it doesn't, impact your credit score that way. And because it's not a loan and it doesn't appear as a loan anywhere, you can use that money to reduce your existing debt, because you're not increasing your debt on one side to reduce it on the other side. You're actually bringing in fresh capital, which is capital from the sale of an asset effectively, and you're using that. So what many people do is they use it to reduce or pay off existing high interest debt. And at the same time as them paying off their debt and removing those awful monthly payments, what it does is it helps improve your credit score, because now you've got a much lower debt to income, or a much lower spending ratio. So it's all sorts of benefits that way.
Wow, I didn't think of that trade-off. The first thing that came to my mind, Matthew, was using those funds to maybe do some home improvements, right? Try to increase the value of the home sooner. But if I have 10 years, I can see how people would just rather make payments towards the debt, because they can rely on the natural appreciation of their property. Because 10 years is a long time. And do you guys have any like exit strategies that, are you guaranteeing them a 10-year, I guess, contract period, or is there any way for you guys to protect yourself outside of waiting that long for those funds, or is that pretty standard?
Well, it's funny you should ask that. One of the biggest challenges of this type of investment for investors is when they say it's an equity investment, so I'm not going to get any rent and I'm not going to get any interest because it's not a loan, and I may have to wait 10 years for these people to sell it.